Welcome everybody. Welcome to your screens on this early afternoon or late morning. We're very pleased to have colleagues here from the ECB to present the excerpts from the November 25 Financial Stability Review. We're going to have two presentations back to back. The first one is going to be on stablecoins, presented by Senne Aerts. The author Barbara Attinger is also on the call, and then followed by a presentation by Dieckelmann on the special feature B of the Financial Stability Review, which has to do with the links between the traditional banking sector and the non-bank financial intermediaries. My name is Florian Heider. I'm the scientific director of SAFE here on the campus of Goethe University. We're very happy to have now been hosting these various presentations a number of times. So just some rules of the game. So you have all access to the Q&A. So if you have questions either during the presentation or after the presentation, there'll be room to answer your questions. If you feel the need that there is something that should be asked right during the presentations, that would only be like highly clarifying questions. So if something is really unclear. Otherwise, I would like to ask you to postpone the questions, or at least be okay with me postponing the answers or relating them to the authors at the end. We should have ample of time to do the Q&A. So without further ado, I hand it over to Senne to tell us more about stablecoins.
Yes, thank you, Florian, and thank you for inviting us and providing us with the opportunity to come and present this material. So indeed, the material that will be presented today is part of the November Financial Stability Review, which is a very comprehensive assessment of the ECB of the financial stability situation in the euro area at the moment. That is a lot of material, and what we will not be covering today, that would be way too much to do in 1 hour. Instead, we decided to highlight, let's say, two topical elements from the Financial Stability Review. Every edition has a couple of boxes and special features that highlight a financial stability topic and go into a bit more on that topic. And for today, we have chosen two specific topics. So the first one on stablecoins, which I will present, and then the special feature on non-bank interlinkages, which will be presented by Daniel. So first on the stablecoins, which was titled "Stablecoins on the Rise, Still Small in the Euro Area, but Spillover Risk Loom." Very important to highlight. I will also be presenting on behalf of my co-authors who were not able to be here today, but I still want to give a shout out to them as well. Then, without further ado, I will present this box on stablecoins into the same structure that you will find the box on our website. So first, I will go into some, let's say, recent developments regarding stablecoins, also reviewing their current use cases and how they are being adopted. Then, of course, from our perspective, very important is highlighting potential financial stability risks that could arise from these stablecoins, and then finally highlighting the current situation and the implications for the euro area. I think many here present probably already have some idea of what stablecoins are. Nevertheless, I would still like to, let's say, reiterate a bit to make sure that we're all on the same level. So stablecoins are a digital unit of value. I think it's quite important. It's all digital, and in particular, digital technology that makes use of blockchain. So think about Bitcoin, Ethereum. This is inherently the same technology, but then built on top of that. Very importantly is that they rely on tools to maintain a stable value. So stable coins are, let's say, within the crypto ecosystem, the tool that has been devised to remain a stable value relative to a currency or another asset. So in many cases, this will be a currency like the US dollar or the euro. It could theoretically also be an asset like gold and so on. But for let's say this discussion, let's just say that in most cases stablecoins are pegged to a currency like the euro or the dollar, and to do so they rely on tools, and that can be algorithms. But nowadays most of the stablecoin market cap is actually backed by fiat reserve assets, and that will actually be very important for our stability assessment later on. So all these stablecoins that you'll see, they try to maintain their stable value by having, let's say, fiat denominated assets, real assets like government bonds, backing the supply of these stablecoins. Now, looking into some recent developments, what we have seen is that the stablecoin market cap has grown a lot in recent years. This has already started, let's say, in early 2020s. So during the 2021 crypto boom, we saw a big increase in the stablecoin market cap. There have been some quiet years overall for the crypto ecosystem, but then also for stablecoins. But then since 2024, we've actually seen that they have been on the rise again. And they are a quite sizable part of that crypto ecosystem. You can see on this chart that they're around 8% of the total crypto market cap is actually stablecoins. And it's dominated by two dollar denominated stablecoins. I think that's quite important to highlight here. So USDT and USDC. Because if we look on the right, we can see actually that also for euro denominated stablecoins, there has been quite a rapid increase in the market capitalization since the beginning of 2024. However, very important here is to highlight the difference in axis. So on the left-hand charts, we're looking at billions. On the right hand, we're looking at millions. So there is really a factor of thousands difference here between the two charts. So they're both rising very rapidly, but euro-denominated stablecoins are already a very small part of, let's say, the collective. It's dominated by US dollar-denominated stablecoins still. Then, of course, why has this been increasing, right? So there has been a reason why are people using these stablecoins, and the primary reason that we see is that at present they are used for trading crypto. So stablecoins, most important use case is just using them within the crypto ecosystem for trading crypto or for decentralized finance purposes. So that can also be seen on the chart on the left. Is that on crypto trading platforms like Coinbase or Binance, stablecoins represent around, are let's say involved in around 80% of all the transactions that occur there. So most of them will be stablecoin to a non-stablecoin crypto, for instance, using your stablecoins to purchase Bitcoin. Some of that is to exchange your fiat to the stablecoin or a stablecoin to a stablecoin. But overall, 80% is actually involving a stablecoin at the moment. So that is the, let's say, primary use case at the moment. There are, of course, potential other use cases. One of which is, for instance, that it's that a stablecoin is global in nature, which means that it flows very easily across border. It doesn't really matter if you send your stablecoin within a country or if you send it to the other part of the world. But inherently, technologically, there is no difference. And also research, and here this is from a recent IMF research who have studied the stablecoin flows in 2024, and what they noticed is that around 70% of all stablecoin flows are cross-regional, meaning that they, for instance, go from North America to Europe or from Europe to Asia and so on. So that's a big chunk of it. So, however, if we look at, let's say, the overall real evidence in the real world of if stablecoins are actually used for cross-border transactions, for sending remittances, we actually do not really see evidence of systematic usage of these stablecoins for that purpose. That doesn't mean that there can be anecdotal evidence of this happening, or that doesn't mean that it cannot be happening, but let's say from the overall perspective, it doesn't seem to be that that is a primary use case for stablecoins at the moment. So in general, looking at everything together, the primary use case for stablecoins is still usage within the crypto ecosystem for trading crypto. That then brings us to the financial stability implications of stablecoins. And there, I think two, let's say, elements are very important to highlight on why we're looking into this. And that is the inherent vulnerabilities of stablecoins and their interconnections with traditional finance, which together create this potential concern. So their vulnerability is that basically there can be a loss of confidence that people can redeem their stablecoins at par. So they hold a stablecoin which is presumably worth $1. there are these tools to try to maintain that value, but it's a tool, right? And it can basically malfunction. That means that at some point a stablecoin can actually be worth less than $1. If that were to happen, and it has happened actually in the past, people might try to redeem their stablecoins all of a sudden. So what would happen is that it is a simultaneous depegging event and a run on the stablecoin. To meet then all these redemption requests, these stablecoin issuers, they would first use their cash reserves, but once they are depleted, what they would need to do is basically sell their reserve assets. And that's where it becomes important, right? So as I said, like having reserve assets like government bonds is what backs the value of the stablecoin. But once you have to start selling these, that might basically create a fire sale event. And then doing that, you might distort some financial markets, in particular those financial markets that are well represented in the stablecoin asset reserves, and we'll come back to that later. Currently, the stablecoin market is only around 300 billion, so that's relatively small. However, if some projections would become true, we would see further significant growth. And if we reach, for instance, by the end of this decade, a market capitalization of over 2 trillion, then that might become a risk. Similarly, another risk amplifier is extreme levels of concentration. We can see, for instance, that just two stablecoin issuers, Tether and Circle, hold around 90% of the of all stablecoins in circulation in terms of market capitalization. So what that means, if there is, let's say, a loss of confidence with one of the issuers, it doesn't even has to be a stablecoin wide event, just like problem with one of the issuers could already have widespread impact. So the combination of these two further significant growth and continued levels of extreme concentration could become worrisome. Looking then at these reserve assets I have been talking about, so why are we looking into this, or what would be, let's say, the impact at the moment, is that we can see that the two largest issuers, Tether and Circle, issuing USDT and USDC, their asset reserves at the moment already are comparable in size to the world's largest money market funds. So they're not small fish, right? So they're already quite sizable. At the same time, a large chunk of their asset reserves is actually held in very short-term US Treasuries. And what we have seen is over this large growth period since the beginning of 2024 is that they have been major acquirers of these short-term US Treasuries. And if you compare them, for instance, with largest foreign buyers, largest foreign holders of these short-term treasuries over this period, we can see that actually Tether and Circle have been quite important in buying these treasuries. So through that way, they could already have some impact on short-term US Treasury markets, actually. Another financial stability risk that we want to highlight, and here this is rather, let's say, speculative. That's also why here you see the if bold, so if adopted widely, household might start to replace their retail bank deposits with stablecoin holdings, right? So if they can use their stablecoins outside of crypto trading, for instance, to make payments, they might actually hold some part of their deposits as stablecoin holdings. And that risk might be amplified if crypto asset service providers are also allowed to pay interest on these stablecoin holdings. However, this is prohibited in Europe by MiCA. So from that perspective, not very attractive. And also in the US, banks are calling for similar bans. So that might actually be, let's say, a push to not have these large outflows. Anyway, if these outflows were to happen, a large chunk of that, or most of them actually, would be recovered as wholesale deposits on the other side, right? So, for instance, if a person buys a stablecoin, that would be an outflow from their bank account, a retail deposit outflow, but he would use that euro, for instance, to pay the stablecoin issuer, who then holds the euro, who also has to deposit it again with a bank. So that would just be a transition from a retail deposit to a wholesale deposit. The euro doesn't disappear. It's just a different type of funding for the bank. And the same is if the stablecoin issuer doesn't hold the deposit himself, but uses the euros, for instance, to buy government bonds, then of course the counterparty selling the bonds would have the euros and they would have to deposit them. So anyway, they would be recuperated as wholesale deposits. So what is then the issue? Basically two things. First of all, wholesale funding in general is less stable than retail funding. Think if there is a stable coin run, stablecoin issuers would need to get their bank deposits quickly to make these redemptions. So it's not necessarily a very stable source of funding. And secondly, it also could lead to higher deposit concentration, right? All the households, they might have their deposits with many different banks. They might all lose a bit of deposits, but they might all go to, let's say, very few banks who work together with, for instance, with these stablecoin issuers. So you might have a flow of, let's say, a lot of retail deposits into a few wholesale deposits with, let's say, wholesale deposit with only a few banks. So the bank funding structure overall might change because of this. But again, we don't see anything of this happening yet. So the stablecoin market cap isn't of the size that we see anything like this. But in theory, if it were to grow significantly, this might occur. And that brings us basically, let's say, the overall conclusion of the box is that for the euro area, that the risks to financial stability from stablecoins are very limited. First of all, because stablecoins are not widely used outside the crypto ecosystem. So outside of crypto trading, we don't see really much usage. The market capitalization of euro-denominated stablecoins is still very small. Only a couple 100 million in the grand scheme of things. That's small. And we already have a very robust, stringent regulatory framework in place with MiCAR, which can mitigate a lot of risk that might arise. So we'll also have to be aware of this, that already is in place, and Europe is really a front runner in that regard. So the only thing that we want to highlight is that stablecoins are global in nature, and that discrepancies of regulations across jurisdictions may pose spillover risk to the euro area. And one of those ways that could happen is through the third country multi-issuance. We highlight this also in the box. Not gonna go into too much that here, what that means, but there are, let's say, risks that just arise from the fact that, you know, in other jurisdictions, the regulations may not be as stringent as they are in the euro area. And that just concludes it overall, just as a summary. So we see that euro area financial stability risks from stablecoins are limited, to a large extent thanks to MiCAR. However, we see rapid growth, and if that continues with new use cases, that could raise some financial stability concerns, and therefore it is warranted that we monitor this closely. One risk that, you know, is already somewhat present and that we want to keep a close eye on is the risk posed by cross-border regulatory arbitrage. These spillover risks really need our attention. And this then highlights the importance to accelerate the global implementation of the G20 crypto assets roadmap. So there is this roadmap which jurisdictions can follow to ensure that the financial stability risk from stablecoins are minimized, and we advise that they are implemented globally. And that brings me to the conclusion of the stablecoin parts, and then we'll gladly hand over to Daniel later for the second presentation.
Thanks, Senne. Thanks a lot for bringing this super topical but still slightly mystical topic of the stable coins closer to the public with that, with that box. And we already got a question in the Q&A, but it has to do with the details of the MiCAR regulation, and so I will postpone it till afterwards. I think let's move on to Daniel for now, and talk a little bit about banks and non-banks, and as so often is, what are the connections between all these slightly more unknown parts and the parts that we presumably understand a little bit better, i.e. the traditional banking sector. So over to you, Daniel.
Yes, Florian, thank you very much. And hello, and early good afternoon from me. I'm Daniel Dieckelmann. Just like Senne, I'm a financial stability expert in the market-based finance division of the ECB. And just like Florian said, so the mystical parts of the financial systems are also the theme of this presentation. In this special feature, which is a sort of 13-page piece in the latest financial stability review, we looked at the systemic risks that emerge from the interlinkages between banks and what used to be called the shadow banking sector and what we now call the non-bank financial sector. Also, this is not only my own work, but also with several other colleagues which are mentioned here on the screen. Next slide, please. So in order to structure the thinking about what risks can emerge between banks and non-banks, I have this slide here, which is not from our report, but it's from a report that was recently published by the Basel Committee. And they basically outline 4 scenarios that really help us understand what risks to financial stability can emerge from the interactions of banks and non-banks. And our report speaks to scenarios 1 and 4, to 2 specific risks, where scenario 1 is the bank provision of leverage to NBFIs, so it speaks to the asset side of banks' balance sheets, and scenario 4 speaks to the liability side. So this is banks' role in the management of NBFI liquidity. So many non-banks, just like investment funds, for example, use banks to deposit the liquidity buffers that they hold, and this creates certain risks. So let me, starting with scenario 4, quickly walk you through the general idea of that risk, and then in the presentation we will go into more detail. The idea here is, if you start with a shock to market or asset prices, it might be that investment funds, for example, are faced with outflow requests. Investors redeem their fund shares, and obviously investment funds hold certain liquidity buffers, but if the redemption requests or the asset price shock is just severe enough, they might exceed what they even hold in liquidity buffers. So this has, one, the effect that they will withdraw this funding from the banks because they hold their liquid buffers at the banks, but also they may have to sell assets, which may further exacerbate the already existing price decline, and it will create risks on the bank side because funding has been flowing out. On scenario 1, on the left side, we jump to the asset side, and let's start again with an asset price shock in markets, for example. If you consider, so one of the main businesses that banks in the euro area are in is the provision of leverage to hedge funds, for example. So you could imagine that a sharp or exogenous shock to asset prices would lead to a deterioration of the balance sheet of hedge funds, which typically engaged in leverage strategy. This leverage is provided by banks, and it might expose the banks to counterparty credit risk should these non-banks fail or not be able to repay their loans. But perhaps more importantly, banks in such a scenario would typically call the margins that they have at the funds. So they would stop the provisioning of leverage. This could lead to the unwinding of leverage position, and then again further exacerbating ongoing asset price corrections or shocks. So you see, the bank-non-bank interactions really are all about also what happens in financial markets. Scenarios 2 and 3 we don't speak about. These are the roles of non-banks in the insurance of risk, and AIG comes to mind here in the global financial crisis, or also equity and ownership links between these two sectors, which we are not discussing just for reasons of space and scope. On the next slide, I'll just briefly name the 3 main areas where that we found in this analysis where banks and non-banks interact and where we see financial stability risks. First, the bank's role in liquidity management of NBFI entities, scenario 4, and the bank roles of providers of leverage to NBFI entities, recall scenario 1. And then third, I will give you a little bit of information on the role of banks as intermediaries, especially in repo and derivative markets. What's new about this analysis is that for the first time in a comprehensive manner at the ECB, we make use of all the granular data that we have. So for many of banks' balance sheet items, we have bank level and non-bank level information, which of course we cannot disclose, but we can use for analysis. And this sort of allows us to paint a more complete picture of these interactions and the involved risks than previously. So on the next slide, I would then start with the funding side. So this is the liability side of banks, scenario 4. So these are redemption and rollover risks that banks face from their exposure to NBFI funding. Overall, euro area banks finance 15% of their assets through NBFI funding. This may appear not much, but it's a quite significant share, and approximately 60% of this funding is very short term and is typically composed of foreign currency instruments. The types of fundings that we're talking about here are deposits, repos, and to some extent debt securities that NBFIs hold. So these are bank-issued long-term debt securities. If you just look at the repo dimension of it, in the middle you see this nice chart that tells you that a third of all of these exposures are overnight. So it could happen that a third of this repo funding to banks can be withdrawn on a daily basis, if you will, and another third is at maturities of less than 1 week. So potentially very volatile. Also, a lot of the very short-term maturity funding is US dollar denominated, which is a sign of intermediation activities from the United States to American hedge funds that Euro area banks engage with, but we'll talk about that in more detail. On the left chart, we've broken down the funding exposures to the non-banks by the type of bank business models. SIP stands for the G-SIPs, so these are the systemically important banks in the Euro area, and you can see that they make up the lion's shares of these exposures. And this will be a recurring theme of this presentation. G-SIPs are at the center of bank-NBFI interactions in the Euro area. However, when it comes to this type of funding, which we know is short-term and tends to be volatile, investment banks and asset manager custodians, IWB and AMC, are actually more of a concern to us. They have lower exposures overall, but their NBFI funding share is higher as indicated in the red dots. And on the right-hand side chart, you can see that also the deposits received from NBFIs for these two bank business models are a lot more volatile than the deposits from other counterparties. So we have short-term maturity, volatility, and then in the next slide, we add to this relatively low share of liquid asset holdings. So going right to the chart on the right-hand side here, on the x-axis, we depict basically the non-bank funding share for individual banks. On the y-axis, you have the liquidity buffers, or HQLA, high quality liquid assets holding over total assets. The idea being here, if NBFI funding is riskier than other types of funding, then if you're in the lower triangle, it means that the funding of this specific bank is not immediately covered by readily available liquid asset holdings. And here again, the same pattern emerges. Asset manager custodians or investment banks, the red and yellow dots are to be found, or excuse me, the yellow and green dots are to be found there, and also some of the G-SIPs in the Euro area. On the left, we just briefly touch upon the concentration of these exposures, and there the story starts to repeat. The blue bars are the main message. The top 5 banks make up the lion's share of the repo funding that is coming from NBFIs, and they're also significant for the deposits that they receive from NBFI. They're slightly different samples, the two of them, but you can imagine that two top 5 banks really make up a large amount of that business. And with this, on the next slide, I want to take you to the asset side of banks. Now we're changing basically the balance sheet side, and we're talking about the lending of Euro area banks to NBFIs. So here, and the most important takeaway is that the asset side exposures of Euro area banks to NBFIs are smaller than the funding linkages. They amount to around 10% of total assets. This means that in the Euro area, the Euro area banks are actually net recipients of funding from the NBFI sector, and this is the opposite of how it is in the United States. In the United States, you will often hear in the Financial Times, for example, that banks provide funding to non-banks which then originate mortgages or loans. This is not the case in the Euro area, and this is important to keep in mind. The majority of credit provisioning to NBFIs is actually towards the so-called OFI, the other financial intermediary sector, and these are typically securitization vehicles. However, investment funds also play a large role. And as you can see on the left-hand side chart, this provision of leverage is typically done via reverse repos, while for other types of non-banks, the composition is a little bit different. On the right, we break this down by on the country level and also by the type of non-bank sector as a recipient of the funding that banks provide. And you see the countries with the large euro area banks coming out first here, France and Germany most notably. On the next slide then, we just very briefly give you an overview of a further analysis that we do. So now that we've identified general exposures to the non-bank sector, we break it down. We try to sort of distinguish different types of non-banks, basically by the fact whether their business model is predicated on the use of leverage. And for this exercise, all others we put a little bit aside. So insurance corporations, money market funds, pension funds, and captive institutions, plus all intra-group exposures, so bank lending to subsidiaries that are non-banks but belong to the banking group, we take out here because they don't typically use leverage, and so we deem them as potentially less risky as the leveraged NBFIs. The leveraged NBFIs then are there are two basic categories emerge. One that use relatively limited amount of leverage for long-term investment goals. Most prominently, this is commercial real estate or residential real estate funds. And then those that are highly leveraged for more short-term market-oriented activities. These are your hedge funds and trading firms, for example. These leveraged NBFIs make up 26% of the total exposure, so 430 billion give and take, which is substantial, but as we will see, it is not enough that per se it would warrant sort of extreme financial stability risks, as we will show you in the next slide. And perhaps here I start with the chart on the right-hand side and basically the positive news. These are exposures to those leveraged NBFIs, hedge funds, commercial real estate funds, and the like. And you see here broken down by bank business model, the percentage of total capital. So the message is there is some dispersion for sure, but the median is relatively low. These exposures are well covered by the well-capitalized banks in the euro area. This is good news. Now, shifting your directions to the left-hand side chart, I want to show you the breakdown of the different bank business models to what type of NBFIs they're lending to. And again, GSIPs emerge. And the yellow bar for the SIP little field there indicates hedge funds. And this is one of the major activities that euro area banks are conducting with the non-bank sector. When it comes to leveraged institutions, they provide leverage to international hedge funds. This funding, as is shown, is in the middle, is typically in the repo market, so those are reverse repos, while for the more longer-term oriented leveraged NBFIs, they are more using term loans or credit lines. Next slide, please. Yes, and this is the part that doesn't have a lot of financial stability messages, so we'll deal with this quickly. This is the last type that we haven't looked at. Those are NBFI issued debt securities held by banks. These are typically not intra-group, and there's a large dispersion across countries. But again, the countries with the largest banks come up here also as the ones most exposed, as you can see on the left. In the middle and by the red bars, you see that this largely comprises securitization bonds, so mortgage or asset-backed securities, for example, and rather less straight bonds, for example, bonds issued by insurance companies or something like this. The credit risk involved in these transactions or in these exposures we deem as relatively low because they're well collateralized. However, one of the financial stability risks in this specific pocket here is the large remaining maturities of such exposures that expose the banks to maturity risk as depicted on the right-hand side. And with this, on the next slide, I'll just walk you briefly to the last major area, And this is the role of euro area banks as intermediaries in repo and derivative markets. On the next slide, and this goes back to the hedge funds that I mentioned, you see on the left-hand side this spectacular growth of banks' reverse repo lending to the NBFI sector. In a nutshell, this lending has doubled in the last 4 years. The exact total amounts here is subject to methodology, but this message you will also find in other estimates. And the driver of this doubling is the basically the yellow part here. Those are non-euro area investment funds. And of these, a large share are hedge funds domiciled in Caribbean destinations. Also, these exposures are highly concentrated, both on the bank side, and I'm not telling you anything new. The blue bar re-emerges. The big banks in the euro area, the systemically important banks, are the one at the core of this business. But also there's concentration on the side of NBFIs. So the top 10% of NBFIs make up the largest share of funding received from euro area banks. The good news from a financial stability perspective are the dots on the right-hand side chart, showing that the most concentrated units also maintain a wide range or much larger number of links, so they well diversify their portfolios on both sides, which mitigates the involved risk a little bit. And on the last slide, I just briefly want to touch upon the intermediation business. Now, our data is constrained by several factors. For example, it is difficult for us to in detail observe what, for example, American subsidiaries of euro area banks are precisely doing, but we know by and large that banks run matched books, both in the repo markets in US dollar denominated instruments, but also in euro-denominated instruments, but also in derivative markets, which is shown on the right-hand side chart. Importantly, this still involves counterparty credit risk and also potentially maturity risk, because it's not clear that even though these positions are net in the aggregate, that on both sides you have similar counterparties or same counterparties or same maturity profiles. I conclude on the next slide just by repeating the main message. Exposures between banks and NBFIs are substantial, but the big difference to the US is banks in the euro area are net recipients of funding from non-banks. Large intragroup activities skew the overall exposures on top. There's two important pockets of systemic vulnerabilities that we see. One come from asset price shocks or redemption flows that work on the liability side of banks, and they may prompt NBFI to withdraw liquidity quickly in times of stress from euro area banks, and they might find it difficult to substitute. We have some analysis on this in previous versions of the FSR. And second, speaking to the asset side of banks, market shocks could sort of enforce or could prompt a pro-cyclical reaction by banks, sort of toning down the leverage provisioning, and by that on the NBFI side potentially exacerbating price shocks. GSIBs, or systemically important banks, are critical for the role in financial intermediation, but they're also the centerpiece of these two systemic risks that we see, and they might be difficult to substitute during market stress, and that's important for policymakers, but also market participants to know. And with this, I give it back to Florian.
Thanks, Daniel. That was a tour de force through the various data that you have access to at the ECB, and that you can use to shed some light on what was formerly called the shadow, right? The shadow banking system, which has a slightly negative connotation, and I guess that's why we call it a non-bank financial intermediation. So for all you out there in front of the screens, this is the time to participate and ask questions. We have 3 questions in that all pertain to stablecoins, so I would start to take them first, and by that time it takes to answer them, maybe we'll have a few more questions on the non-bank financial intermediation as well. So let me first start with a question by Shihan Duran. It's a relatively long question, but the point is that in MiCA, you know, EMT, so electronic money tokens, so stablecoins, basically, they on the asset side they require bank deposits. And now, if we worry about stability risks coming from the interconnection between banks and stablecoins, aren't we hardwiring the problem relative to the US, where the asset side seems to be dominated by treasuries? And so the question is, so he says, I am wondering why European policymakers are not opting for more short-term govies that could find demand from EMT issuers if euro stable coins adopt. And then he thinks, so is this a flaw in the regulation in Europe from a financial stability point of view?
So thanks a lot for the question, and good afternoon to everybody. So yeah, happy to take this question. So indeed, you are right. So MiCA requires at least 30% of reserves to be held in deposits, and this even goes up to 60% in case of significance. So actually what the legislator wanted to achieve was that indeed these stablecoin reserves are high quality and liquid, so that in case of a redemption request to the stablecoin issuer, the redemption can be made by tapping on these bank deposits. So this is, of course, a valid and per se stabilizing intention. You are also right, obviously, that this creates an interconnectedness between the stablecoin issuer and the banking system. And as Senne also explained in his slides, we see sort of a two-sided mechanism. So if, and it's a big if, stablecoins would pick up a lot and retail deposits would flow into stablecoins, then we would, via this mandatory bank deposit holdings, see a wholesale deposit inflow into the banking system. And as Senne also mentioned, indeed, these wholesale deposits are per se more flighty, and banks have to manage them differently in terms of liquidity risks than they manage retail deposits. So on your question, actually, we have to monitor the space a bit. I think the MiCA provides a sound and valid framework, so I wouldn't describe it as a flaw, as you sort of catchily put it now in the question. But we have to see, MiCA was first in regulating this new space, and there is a mandatory MiCA review planned for 2027, where we will also look in how did the space evolve, which sort of data points could we pick up. And that would be, for example, one provision, so these mandatory deposit holdings, where I would expect that we may see some, where we may gather some experience and look into this again. But for the time being, I wouldn't describe it as a flaw. Thanks.
Thank you very much. That was just me trying to be a bit provocative. It wasn't in the original question, in all fairness. The second question is by Tatiana Farina. She writes, it's true that MiCA is very stringent, but are its provisions the correct approach according to the risks you raised? It's quite a different piece of legislation in the American Genius Act. In addition, are there opportunities for Europe that may emerge with stablecoins, perhaps dominating euros? Okay, so I guess the question is that you haven't really talked about the Genius Act, maybe by design, I guess by design, but it's a very different approach, right? I mean, the regulation is very, very different, not only the asset side, but also on other dimensions. So can you maybe comment on that and what opportunities you see? Because that's really striking, right? That almost all stable coins are dollar denominated. They're private initiatives, and we don't really see anything like that in Europe. And if anything, we're talking about whether the public sector should somehow push. And it seems very different on those two fronts.
So thanks a lot again for also this very interesting question. Indeed, we didn't now raise a lot issues about the Genius Act in this presentation because our box was not so much on the Genius Act. But of course, we are monitoring the space very closely. And indeed, it links a little bit to the first question because the Genius Act doesn't oblige 30% of reserves holdings in bank deposits, and it provides indeed for a wider pool of assets or of reserves. Let me mention on the Genius Act, it is so far, it has to be implemented. So we will only know how exactly it plays out once we see the concrete implementation in the US. And but what we can already see is that in terms of reserves, it's more open, and importantly, it also doesn't specify capital requirements, and also it allows redemption fees, which are prohibited under MiCA. So now on your question of opportunities in Europe for euro-denominated stablecoins. So indeed, actually, we think that well-designed and properly MiCA-regulated stablecoins in the EU are indeed an opportunity and would sort of be part of the digital space in the EU. So basically, let me read your question again. In addition, are there opportunities for Europe that may emerge with stablecoins? Indeed, so basically, what is key is the innovation potential of the technology. And there, stablecoins, if well regulated and well designed, are one means to reap the technological benefits. There are other technological forms like tokenized deposits, and there's importantly also central bank money like the digital euro or wholesale CBDC, which are part of this innovative digital money space. And we think that these different forms of private and central bank money will coexist, and we should, as Europe, look at the potential of technology and have a proper regulation. And so stable coins, if well regulated, are one part of this.
That's very interesting. Let me just we might move on to the other question, but my first reaction, it illustrates the very different approach on the sides of the Atlantic, right? In sort of the US, it's like, do it first and regulate later if it sort of explodes. And in Europe, we seem to be saying, to have that stuff, we need to have first the regulation in place. And I am not sure which approach is better. Anyway, it's just a notice that also in this discussion, this really is a very stark contrast that we have something that's out there that's not that much regulated, right? Tether is in El Salvador. And we in Europe, we think that we need to first have the regulation in place and then the private markets will follow, which I think is an important or interesting question for economics in general. I don't have the answer, but it's sort of interesting. The question I think now, the next question is brings us maybe a little bit closer to the presentation again, maybe just explaining a little bit more how. So the question is, these fire sales of stable coins. So I'm not sure whether it's the fire sale of the stable coin or the fire sale of the assets backing the stable coin, which are used as collateral in interbank transactions. So maybe when the stable coin itself is a collateral for something else, could impair the functioning of interbank markets, potentially exacerbated by higher repo haircuts. So yet maybe another connection between the stablecoin universe and the traditional banking. What's your view on that?
Yes, certainly. I think when it comes to, let's say, the financial stability implications of stablecoins, it's also very important to start from the use case of these stablecoins. And that's also why we dedicated like a specific lengthy paragraph in our box on this. And I also wanted to talk about this in this presentation, is that currently we see stablecoins mostly used for trading crypto. And I think also answers to, I think, your previous question, why so much dollar domination, because of this use case, right? It didn't make a lot of sense to have these markets also a euro-denominated stablecoin to trade with. It's just like in the traditional financial markets, you need to kind of have your base unit, and that's the US dollar. Let's say in a lot of financial markets and in the crypto space, this was the US dollar denominated stablecoin. So based on that use case, a lot attention has gone to dollar denominated stablecoins and not so much to euro denominated stablecoins. When it comes to the future to adoption of new use cases, they're actually, and that against answer to the opportunities and the importance of MiCA, we think that having this, let's say, solid legislation in place helps to develop further use cases. Answering then to this question, I think because it connects to that, using stablecoins as collateral in interbank transactions would be yet another, let's say, potential use case for stablecoins, which we at present don't really see. So talking about this as a financial stability risk when we don't really see adoption of this use case yet, this is kind of speculative. At the same time, we do see that there is quite some momentum for the overall underlying technology of stablecoins, the DLT. We see that tokenized assets, tokenized securities are gaining attention. And with that, of course, there comes, let's say, the role potentially of stablecoins, but not necessarily stablecoins. There can be alternative to this. And Barbara has also highlighted this: tokenized deposits, a wholesale CBDC. These might fulfill very similar roles. And it will be depending on, let's say, the participants on which they think is the best fitted solution, they will probably pick the one that makes most sense. So then looking, for instance, specifically at here, using stablecoins as collateral in these transactions, a stablecoin like Tether, I think S&P latest came out with really saying, okay, this is basically junk. They gave it the lowest rating possible, and also in their qualitative description of it, they weren't really very positive about stablecoin. I think such a stablecoin won't be used for that purposes. Whether other stablecoins, which are maybe more trustworthy, will be used, that will the markets might have to decide. At least for now, it seems that the risk stemming from this specific element that is highlighted is not very large. But yeah, the future will have to define if that might become the case.
Okay, thanks a lot. We don't really have any other question yet. I mean, there is a question, but it's not on substances. Could you share the slides covering the NBFI issue? I don't know what your policy is, but I guess you will find, in any case, all the material in the special feature. So
just like you said, Florian.
Yeah. I guess you can paste and copy and do your own slide deck and re-engineer. Yeah. I don't think you've presented anything that's not in there, correct?
That's correct. I would have to check if the slides were that important, but I can sort of guarantee it's one-to-one the same that's in the special feature online.
So let me break the ice on the NBFIs. I mean, there was a lot of information, and I have a trouble recalling the sort of the main message. I guess the main message is that if you look at the data, I mean, there are these connections, but the connections are probably rather limited, in particularly to the highly levered hedge funds. Now, one thing, of course, that you mentioned and which struck me is that is the funding side, so that the NBFIs are hold a lot of deposits. And I'm wondering, this is something one often hears, is that a consequence of QE? And what would it mean if you do QT, right? The idea is that, who holds euro area government securities? It's the NBFIs. They cannot go to the ECB, so they use a bank or someone else, I guess a commercial bank, that has access to the ECB's facilities. And after the transaction, you end up with a commercial bank that has a lot of deposits from the NBFI and a lot of reserves. And also in your cloud, right, with the high liquid assets, there was a lot of there. Is that something that you would say has because that would have created that situation, or is the situation also for structural non-monetary reasons? And if it's a little bit both, how would you see that now that we are basically, or the ECB is running down the balance sheet? Will that persist? Will that normalize? I'm just curious whether you have any. It's not in your presentation per se, but as an expert in that area, what's your take on that?
Yeah, thanks, Florian. That's a great questions. A lot of unpack. Maybe I'll just start quickly by reiterating sort of the main messages, just because I know this is really a wealth of material and it's really nitty gritty. So basically the main takeaways is we see pockets of vulnerabilities, and we have these two scenarios, one on the asset side where banks stop providing leverage, and then on the liability side where these NBFI might withdraw this funding to the banks relatively quickly. But if we look at the aggregate numbers, there is sort of no reason for alarm if we monitor these vulnerabilities closely. Also, an important takeaway is the different structure, just like you mentioned, Florian, this sort of important part of NBFIs being funding providers to bank, which makes it fundamentally different from the United States, which is usually at the forefront of the discussion. And then the last main message would be the central role of the systemically important bank in the middle of basically all of it. Now, is this or are these trends a consequence of QE? What about QT, so quantitative easing, quantitative tightening, and are there also structural factors at play? So maybe I start with the latter. It's for me always, of course, a little bit difficult to sort of comment on monetary policy, but there's certainly some structural factors that we observe. One is regulatory arbitrage. At least sort of the evidence seems to be that some of this business that especially Euro area banks are doing with US entities has to do with the fact that sort of, for example, that the US funding is flowing from the US to Euro area banks, is intermediated and then in form of a reverse repo given out to hedge funds that are in the Cayman Islands, which is like a substantive sort of share of the asset side exposure. That is probably due to regulatory arbitrage, or also for the hedge funds to sort of diversify their set of counterparties. So this is something that we're seeing. Another structural reason is perhaps the growth of debt securities outstanding, especially government debt. So certain types of NBFIs, especially leveraged NBFIs, are becoming a lot more important for sovereign debt markets overall, and that deepens also the links with the banking system. So again, hedge funds would come to mind here, for example. Then on the funding side of banks, it is true that because of QE, or perhaps I phrase this differently, non-banks in the euro area don't have access to the balance sheet of the central bank, of course. So one natural way to gain access is through the deposits of banks. And if you will, banks are a little bit in an intermediation role. They're in the middle. They could park excess reserves that they're receiving as deposits then, for example, with the central bank, and receive the DFR, the deposit facility rate, in return. Now with QT, there is a we observe a shift. Price-sensitive market participants are becoming more important. So this might also change the way bank NBFI linkages play out. But yeah, perhaps with my answer, I would leave it at that.
Excellent. Thanks a lot. And I'm having an eye on the clock, and I think we are spot on. 1 minute to go until 1 o'clock. Let me say that I really enjoyed the presentations, the discussions, because it's rare that you get a glimpse based on data in these slightly more obscure areas of finance, also the stable coins. I mean, I looked a little bit on where you got the information from, because it's actually not easy, and it's a lot of pedestrian work getting all this stuff sorted out. So congratulations. I urge everyone to look at the Financial Stability Review. It's a wealth of information. And with that, I would like to thank the presenters, but also you on the screen for attending. And yeah, have a great rest of the day, and until the next presentation of a financial stability report of the ECB, hopefully. Bye-bye.
Thank you very much. Bye-bye.
Thank you. Bye.